Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Introduction to Asset-Liability Management. Asset-liability management is a critical practice for financial institutions and corporations to manage risks related to assets and liabilities. ALM aims to ensure financial stability and profitability by aligning the maturities and cash flows of assets with those of liabilities. This alignment helps in mitigating various financial risks, including interest rate risk, liquidity risk, and currency risk. Understanding ALM is essential for professionals in risk management roles, particularly those pursuing certifications, such as the Associate Professional Risk Manager. The core of ALM is the strategic coordination of assets and liabilities to optimize the risk-return profile of an institution. This coordination involves identifying, measuring, and managing risks that arise from mismatches between assets and liabilities. A key component of ALM is interest rate risk management. Interest rate risk arises when changes in interest rates affect the value of financial instruments. For instance, a rise in interest rates can lead to a decrease in the market value of fixed income assets, while the cost of liabilities may remain unchanged or increase. Effective ALM strategies involve the use of interest rate derivatives, such as swaps and futures, to hedge against these risks. Liquidity risk is another significant concern in ALM. Liquidity risk occurs when an institution is unable to meet its short-term obligations due to a lack of liquid assets. This risk is particularly pertinent for banks, which must balance the need to hold liquid assets to meet deposit withdrawals with the desire to invest in higher-yielding, less liquid assets. ALM practices, such as cash flow matching and liquidity gap analysis, are employed to manage this risk. Cash flow matching involves aligning the cash inflows from assets with the cash outflows required to service liabilities, thereby ensuring that sufficient liquidity is maintained. Currency risk, or exchange rate risk, is another aspect of ALM that needs careful attention. This risk arises when an institution has assets and liabilities denominated in different currencies. Fluctuations in exchange rates can lead to significant gains or losses. To manage currency risk, institutions use various hedging techniques, including currency forwards, futures, and options. By locking in exchange rates for future transactions, these instruments can mitigate the impact of adverse currency movements on the institution's financial position. A practical example of ALM in action can be seen in the banking sector. Banks typically have long-term assets, such as mortgage loans, and short-term liabilities, such as customer deposits. This mismatch can expose banks to interest rate risk if the interest rates on deposits rise faster than the rates on loans. To manage this risk, banks often use interest rate swaps to convert fixed-rate loans into floating-rate loans, thereby aligning the interest rate sensitivity of their assets and liabilities. This strategy helps in stabilizing the bank's net interest margin, which is the difference between the interest income generated from assets and the interest expense on liabilities. In addition to managing risks, ALM also involves performance measurement and optimization. Performance measurement in ALM focuses on assessing the profitability and risk-adjusted returns of different asset-liability strategies. Key performance indicators used in ALM include the net interest margin, return on assets, and return on equity. These KPIs help institutions evaluate the effectiveness of their ALM practices and make informed decisions to enhance their financial performance. Optimization in ALM involves finding the optimal balance between risk and return. This process requires sophisticated modeling techniques, such as scenario analysis and stress testing. Scenario analysis involves assessing the impact of different hypothetical scenarios on the institution's financial position, while stress testing evaluates the institution's resilience to extreme but plausible adverse events. By using these techniques, institutions can develop robust ALM strategies that maximize returns while minimizing risks. The regulatory environment also plays a crucial role in shaping ALM practices. Regulatory frameworks, such as the Basel III Accord, impose stringent requirements on capital adequacy, liquidity, and leverage ratios. These regulations aim to enhance the stability and resilience of financial institutions by ensuring that they maintain sufficient capital and liquidity buffers to absorb losses and meet their obligations. Compliance with these regulations necessitates effective ALM practices to manage the trade-offs between regulatory requirements and business objectives. Technological advancements have further transformed ALM practices by enabling more sophisticated risk modeling and real-time monitoring of financial positions. Advanced analytics, machine learning, and artificial intelligence are increasingly being used to enhance the accuracy and efficiency of ALM processes. For example, machine learning algorithms can analyze vast amounts of data to identify patterns and correlations that may not be apparent through traditional methods. These insights can help institutions make more informed decisions and improve their risk management capabilities. In conclusion, asset liability management is a fundamental practice for managing the risks associated with the mismatches between assets and liabilities. By aligning the maturities and cash flows of assets with those of liabilities, institutions can mitigate interest rate risk, liquidity risk, and currency risk. Effective ALM practices involve the use of derivatives, cash flow matching, and hedging techniques to manage these risks. Additionally, performance measurement and optimization are essential components of ALM, enabling institutions to assess the profitability and risk-adjusted returns of their strategies. Regulatory requirements and technological advancements further shape ALM practices, ensuring that institutions maintain financial stability and resilience. Understanding and implementing robust ALM strategies is crucial for professionals in risk management roles, particularly those pursuing certifications such as the Associate Professional Risk Manager. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.